What if I told you that picking the wrong ETF, even a decent one, could quietly cost you over $500,000 in future wealth? Stay to the end. We'll compare 5 ETFs and show a $7 a day SCHD plan that research projects could grow to about $953,000 and generate roughly $75,000 a year in dividends. Most investors don't realize how much is at stake. In this video, I'll walk you through 5 of the most popular dividend ETFs, the exact criteria I use, and the one that stands out clearly as the best choice. And the danger is, at first glance, all of these funds look safe. Here's the problem with pretty good ETFs. Small design choices in how they're built, what companies they hold, how dividends are handled, and even the fees charged compound into huge differences when you stretch the timeline out 10 to 30 years. A fund that looks safe today can quietly cost you hundreds of thousands of dollars in future wealth and tens of thousands in annual income later on. Here's what that really means in practice. First, dividend yield alone doesn't tell the full story. A higher yield might look good up front, but if those payouts don't grow, your income stays flat against rising living costs. Second, dividend growth matters. A fund that consistently raises payouts, even from a lower starting yield, can turn into a much stronger income stream later. Third, total return. Share price growth plus dividends drives long-term wealth. You need both, not just one. Fourth, fees eat away at compounded gains. That fraction of a percent in year 1 looks trivial, but stretched across decades, it becomes tens of thousands shaved off your portfolio. Now let's put these ideas into a real-life example. Imagine you set up a simple habit of investing $7 a day, which comes out to about $200 a month. Fast forward to year 20, and your portfolio could be worth about $290,000, with dividends crossing roughly $12,000 a year. That's with a fund designed to balance both dividend growth and total return. But pick a fund that skimps on payout growth or charges more in fees, and you'd likely end up with far less. Same dollars invested, same time horizon, just a dramatically different outcome because of those smaller design choices. This is where the danger of pretty good really shows itself. On the surface, 2 ETFs might boast similar starting yields, say 3% each, but over time, the one that steadily increases its payouts builds real financial power. The other might plateau. When you run the math 30 years out, one investor could be cashing dividend checks big enough to cover a comfortable retirement, while the other is wondering why their income hasn't kept up with basic expenses. Both funds technically worked, but one worked a whole lot harder for the investor. Many investors underestimate just how powerful these differences are. They often overlook how fees slowly drag down returns, or how stagnant dividends fail to keep pace over decades. It's not that they're reckless, it's that they assume a major fund with a familiar name must automatically give them the best chance at success. But settling for average in this case can quietly erase what should have been life-changing amounts of wealth. Pretty good isn't neutral, it's costly. That's why the real change is choosing an ETF that balances growth and income together. Stock price appreciation keeps your wealth expanding, while dividend growth ensures your income snowballs. Miss that balance, and you never unlock your portfolio's full potential. And the differences here aren't minor, they're massive. Over decades, the right ETF choice is the difference between scraping by and living with confidence. So the question isn't whether pretty good is enough. The question is, given the long-term impact these design choices have, how do the most popular dividend ETFs actually compare when you put them side by side? Are they as strong as they appear on paper, or is one of them decisively better than the rest? Here are the 5 funds we'll compare and the exact criteria we'll use. Total return, price plus dividends, dividend yield and dividend growth, fees, risk and volatility, and the quality of the companies inside. That way, you'll see not just how each ETF looks on paper today, but how well each one is positioned to build wealth and income over decades. Think of them like 5 different plates on a small menu. SPY is the growth-heavy option. VIG is the quality dividend growers. VOE is the value-focused plate. DVY is the income-first choice. And SCHD aims to serve a balanced meal with the best parts of each. That's the setup. Now let's walk through them one by one. SPY is the original giant. Launched in 1993, it was the first ETF in the United States and remains the largest by assets today. It mirrors the S&P 500, giving you exposure to the 500 biggest U.S. companies. Its strength is simple: capital appreciation. Over long stretches, SPY has delivered impressive overall growth, fueled by tech leaders like Apple and Microsoft. The trade-off is that its dividend yield is light. If your focus is future income, SPY can build your wealth rapidly, but it won't hand you much in the way of cash flow along the way. You'd likely need to sell shares to create consistent income later. VIG takes a very different angle. Instead of just paying attention to today's dividend, it selects companies that have a proven history of raising their dividend year after year. That steady growth makes it an appealing choice for those who want reliability and efficiency, especially with its very low expense ratio of 0.06%. Its top holdings include well-known, stable companies across technology, healthcare, and financials. Still, investors who prefer higher payouts right now may find VIG underwhelming, since its current yield is modest compared to other options. Its real power is in what happens over time as those dividends keep climbing. VOE, the Vanguard Mid-Cap Value ETF, is often chosen by investors who believe in the strength of value investing. It leans toward mid-sized and larger U.S. companies that appear undervalued relative to their fundamentals. Its sector mix typically spans financials, industrials, and utilities. Over the past decade, VOE's performance has been solid, though not spectacular, which matches the slow and steady profile of value-oriented investing. It offers moderate yields, low fees with an expense ratio of 0.07%, and manageable volatility. Many investors overlook it because it feels middle of the road. But for some, that exact balance of value and stability is the appeal. DVY is built for income now. It leans heavily on utilities and other traditional dividend payers to generate a higher starting yield than the others in this lineup. That makes it attractive to someone who wants to see tangible cash hitting their account right away. But the catch is long-term growth. While it delivers in year one, DVY has historically lagged funds like SPY and VIG when it comes to total wealth after a couple of decades. Its volatility can also surprise people who assume income funds are always low risk. With DVY, you're trading away some future balance growth in exchange for higher upfront payouts. Finally, there's SCHD. Unlike the others, SCHD was designed from the ground up to combine yield, growth, and quality. It screens companies carefully, requiring at least 10 years of consistent dividend payments, strong profitability metrics, and healthy balance sheets to make the cut. The expense ratio is an ultra-low 0.06%, and its yield typically sits above SPY and VIG. That's why many investors call it a well-rounded choice. It balances meaningful current income with dividend growth and long-term stock appreciation without compromising too much in any single area. Now, the interesting part isn't just how these funds look when you read their fact sheets. It's what happens when you take the same investment habit, say that $7 a day, and let each of these ETFs carry it forward for for decades. The differences in returns, yields, and future income are striking. When you weigh those trade-offs carefully, one of the options consistently rises above the rest. So, which of these funds actually earns the spot as the strongest choice for long-term investors? The answer is SCHD, the Schwab U.S. Dividend Equity ETF. It stands apart because it doesn't force you to choose between growth, dividends, or stability. Instead, it combines all three into a single package that's built for investors who care about both wealth building and dependable income. SCHD's advantage starts with its design. Every company in the fund must have paid dividends for at least 10 consecutive years, show strong profitability, and maintain healthy balance sheets. That screening process weeds out weaker firms and ensures you're only holding companies with proven reliability. Right now, SCHD holds about 103 different stocks, striking a balance between diversification and focus. Roughly 40% of the fund is concentrated in its top 10 holdings, names like PepsiCo, Chevron, and Texas Instruments, companies that may not be flashy, but deliver profits consistently. Numbers make this case even clearer. SCHD charges an expense ratio of just 0.06%, one of the lowest in its category, which means you keep more of your returns over decades. Its standard deviation is around 14.64, showing it balances growth potential with moderate volatility. Over the past decade, the fund's value has increased by more than 113%, while continuing to pay out reliable income. Trailing 12-month distribution yield, 3.87% as of July 31, 2025, paid quarterly. For investors who reinvest these payouts, that cash flow turns into even more compounding power, fueling both income and growth. Compared directly to its peers, the case becomes sharper. SCHD yields higher than SPY and VIG, which both lag in dividend payouts despite strong long-term growth. Unlike SPY, SCHD filters every holding for dividend history, so income is prioritized from the start. Compared to DVY, SCHD holds higher quality dividend growers across diversified sectors, not just utilities, which limits concentration risk. And against VOE, its profitability screens and dividend requirements make it stronger while still incorporating value discipline. Add in the fact that its costs stay ultra low at 0.06%, and it's clear SCHD pulls together the most important strengths without taking on the weaknesses. That combination makes SCHD especially compelling for anyone with a long horizon. You aren't betting on tech dominance like SPY does, or giving up growth for income like DVY. Instead, you get an ETF that provides steady dividends today, consistent dividend growth going forward, and enough capital appreciation to keep pace with the broader market. It's a fund structured with patience in mind. Low turnover at just 29% shows disciplined management rather than chasing trends. For investors focused on building wealth with confidence, those safeguards matter just as much as the growth potential. Think of SCHD as a framework designed for resilience. The companies inside it come from essential industries, consumer staples, energy, healthcare, that have proven to generate cash even in downturns. This isn't about chasing hype. It's about holding businesses that actually pay and keep paying, while also leaving room for share price growth. That's what separates SCHD from options like DVY, which lean too much on one sector and risk being left behind when markets shift. Put simply, SCHD isn't just good enough, it's structured to be an efficient, long-term wealth-building tool. You gain exposure to companies strong enough to navigate economic cycles, you save money on fees that would otherwise eat into compounding, and you collect dividends that are both meaningful now and positioned to grow meaningfully over decades. That blend of growth, income, and risk management is rare among ETFs, and it's why SCHD consistently earns its reputation as the standout choice. But here's where the impact really comes alive. When you pair SCHD's design with a steady, simple habit of investing small amounts daily, the numbers show just how powerful the results can be. $7 a day may not sound like much, but the long-term math tells an entirely different story. To make this clear, let's set the ground rules for the projection we're using. The assumptions are based on historical data, a starting dividend yield of around 3.75%, dividend growth averaging about 10.77% per year, and share price growth averaging roughly 7.61% per year. Dividends are reinvested in full, which is what fuels the compounding over time. With that framework in place, we can see exactly what a small daily habit can become. At the end of year 1, you've contributed about $2,555. The account doesn't look impressive yet, growth hasn't had time to work, and the dividends paid out amount to only a handful of dollars. This is the stage where most people underestimate the process, but the important question isn't what 1 year looks like. It's what happens when each year builds on the foundation of the previous one. By year 10, your daily $7 habit has added up to roughly $25,000 in contributions. Thanks to reinvested dividends and steady appreciation, the account value could be nearer to $45,000. Just as important, the dividends alone are bringing in about $2,000 per year. That's money you could use if you needed to, but leaving it invested is what makes the snowball start rolling faster. At this point, you start to see the clear impact of both dividend growth and price growth working together. Skip ahead another decade to year 20. Now you're looking at a balance of about $290,000 with annual dividends surpassing $12,000. That's roughly $1,000 a month in passive income. The difference between year 10 and year 20 is striking. This is where true compounding shows its strength. Dividends are no longer small, they're material, and when reinvested, they generate even more shares, which in turn generate even more dividends. This is the feedback loop that rewards long-term consistency. By year 30, the numbers have become transformative. The account balance is projected to hit around $953,000, nearly $1 million, built from a daily habit that costs less than many people spend on coffee. But the most important figure isn't the balance, it's the payout. At that stage, the dividends are expected to provide about $75,000 per year, which breaks down to around $6,250 a month. That is recurring income before you even touch principal. These numbers are based on historical averages and the assumptions I just listed. Past performance is not a guarantee of future results. Think about the practical meaning of $75,000 in yearly passive income. For many people, that could comfortably cover rent, student loan payments, utilities, or everyday living costs without working a single additional hour. And all of it can come from simply maintaining a small, consistent habit rather than relying on big windfalls or timing the market. When you compare these outcomes with other ETFs, SCHD's advantage stands out even more. SPY projects to about $650,000 after 30 years, but the dividend income is only around $1,000 annually. VIG ends closer to $530,000, yielding about $4,000 in annual income. VOE, which emphasizes value, grows to about $450,000 in balance with dividends near $22,000 per year. DVY, designed for income, delivers about $528,000 with around $31,000 in annual dividends. By contrast, SCHD provides nearly double the balance of VOE and more than triple the income of DVY, finishing with $953,000 in value and the highest projected cash flow, $75,000 each year. It's one thing to see numbers on a chart and another to realize what they mean for an actual retirement. Choosing the wrong, pretty good ETF could leave you with a couple $1,000s in dividends per year, a helpful supplement, but hardly enough to change your financial life. With SCHD, that same daily commitment could translate into a self-sustaining stream of income large enough to fund a lifestyle with real options and security. And that's the deeper point. The choice isn't just about seeing bigger balances on paper. It's about what kind of freedom you want to secure for yourself 30 years from now, and whether your daily actions today will build toward that reality. Choosing the right ETF isn't just about comparing returns. It's about making a strategic decision that shapes your financial future over decades. That decision can create the stability to retire confidently, support your family, or simply know you'll have reliable income when you need it. The key factor is discipline. Even $7 a day directed into a fund. You don't need to wait for perfect timing. You need to keep showing up consistently. If you want one ETF for a long-term mix of growth and income, the research-backed pick here is SCHD, and the real power comes from starting small and staying consistent. If you want a step-by-step plan for turning dividends into a steady monthly paycheck, click the video on screen. If this helped you, like the video and subscribe for practical investing breakdowns. If you have questions about the assumptions or want me to show the math step by step, drop a comment.